approach to investing has shifted from buy and hold to buy and protect. Many investors feel more confident in buying a stock than in selling one. However, protecting your portfolio will likely require that you occasionally sell a stock for a small loss in order to avoid a larger loss. In the next 3 minutes, we'll look at some basic strategies you can use to protect your portfolio. Your first step should consist of researching your investments before you buy. As consumers, we live by the motto, caveat emptor, let the buyer beware. The idea is that we need to know what we're buying before making a purchase. The same principle holds true in the stock market. Just because a company is listed on a national stock exchange does not mean it's a sound investment. Of course, companies must meet certain requirements in order to sell their shares to the public. However, you still need to take the time to make sure the company you're considering meets your investment objectives. A good understanding of the company fundamentals can be helpful. Consider reviewing one or more of the following: earnings and dividends, how much profit the company makes for a period and how much gets paid out to shareholders; market capitalization, the total dollar value of all company shares, calculated by multiplying the shares outstanding by the current market price; institutional ownership, what percentage of the shares are owned by mutual funds and other institutions. The next step in the process is to know the long-term trend. You should look at the trend before you make your investment, and then you should monitor it afterward. Don't get caught up in the day-to-day volatility. Look at a 5 or 10-year weekly chart, for example. If the price generally moves from lower left to upper right, then the trend for that time period is moving higher. Stock prices move higher when buyers are in control and money's moving into the stock. As with any other investment, continued demand helps to drive prices higher. On the other hand, a price chart that moves from upper left to lower right indicates a downtrend. This tells us that sellers are in control, or that demand is waning and the price is falling. Next, consider your risk versus the reward for your investment. Once again, this step should be done before you make the initial investment and then evaluate it on a regular basis. Every investment involves various types and levels of risk. You need to be sure that the risk you're taking is justified by the profit you can reasonably expect. This is another area where the stock price charts can help you. The charts will show you price levels known as support and resistance. These are the historical price levels where the stock rises and falls. While not a guarantee of what the stock will do, it can serve as a guide for your decisions. For example, you may see that a stock has risen to $30 several times over the last year and then fallen to $20. If it's hovering around $30, you may decide to wait until either it falls or rallies above $30 before you buy. That would be better than buying it at $30 and then losing 30% if it should happen to drop to $20 once again. Protecting your portfolio does not require that you watch the market day in and day out. A stop order is a tool that can help you limit losses and capture gains automatically. A stop order is a special type of order that only activates if your predetermined price is reached. Finally, consider your entire portfolio and not just select positions. Protecting your portfolio may mean you include some types of investments that stay flat or even drop a little when most of your stocks are going higher. However, that same investment may go higher when the rest of your stocks are underperforming. That's the idea behind a diversified portfolio. Learn more about smart investing with E-Trade's free investing tools, live events, web seminars, and videos. Thank you for joining us.